Here's the part that messes with people. Palantir reported no bad news, no earnings miss, no guidance cut, no scandal, and it still fell to a fresh 52-week low under $108 a share, capping one of its worst months since it went public. What's up, guys? Coach B here. This is the playbook. Quick reminder up front. This is education, not financial advice. I'm not telling you to buy Palantir, and I'm not telling you to short it. What I want to do is show you one of the cleanest examples in the market right now of a stock that fell on no company news at all. Because once you understand why that happens, you stop getting blindsided by it. So let me set the table. Late May, Palantir was trading around 156.57 a share. That was the high water mark. From there, it just bled. By the middle of June, it was in the low 130s. The week of the 22nd, it cracked again. From the close on June 18th, around 128, down to the close on June 26th, near 113. That's about a 12% drop in 5 trading sessions. And on June 25th, it printed an intraday low around 107, the lowest level in a year. Now, here's the kicker. On the actual down days, there was no fresh disaster out of the company. So if it wasn't company news, what was it? The word for what happened is a re-rate, and it's one of the most important ideas in this whole game, so let me make it plain. A re-rate is when the market changes the price it's willing to pay for $1 of a company's earnings. Same company, same earnings, but a new multiple. The business didn't get worse. The market just decided it would no longer pay as much for it, and Palantir was priced for perfection. At its peak, it was trading at roughly 128 times its trailing earnings. Let me put that in plain dollars so it lands. 128 times earnings means you are paying $128 for every $1 the company earns today. For comparison, the broad market trades somewhere in the low 20s. So you are paying roughly 5-6 times the going rate. When you pay that, you are not buying what the company is. You are buying years of everything going perfectly in advance at full price. That's the trap with the name price for perfection. The expectations are the bar. To go up, it has to beat perfect. And no bad news isn't beating perfect, it's just meeting it. So the stock can derate on a day when literally nothing went wrong because nothing went wrong was already in the price. Now the second piece, and this is the real lesson, the thing that re-rated Palantir wasn't really about Palantir. It was about the whole theme Palantir is valued on. Here's the fear that's been rolling through the entire AI software complex. The worry is that AI agents, the same kind of AI these companies sell, get good enough to replace the seat-by-seat software businesses underneath them. In other words, the thing they sell becomes the thing that eats them. You don't have to believe it's true. The market only has to fear it's true to pull the multiple down across the whole group. And when a theme re-rates, it drags every name priced on that theme, whether or not that specific company put out any news. Palantir is just the cleanest example because it ran the furthest and was priced the steepest. So when the market got nervous about the story, the most expensive name on that story had the most air to come out. Yeah, there were headlines around the edges. France's intelligence service is reportedly phasing Palantir out for a domestic alternative, and UK members of parliament renewed pressure to terminate a big NHS data contract at its break clause. Worth knowing. But those are sideshows. They are not what took a stock from 156 to 107. The theme re-rate is the story. All right, so how would I actually think about a name like this? Not as a buy, not as a short, as a lesson in respecting the multiple. When a stock is priced for perfection, I don't want to be the person buying the parabola at 156 on the way up, and I don't want to be the person panic puking at 107 on the way down. Both of those are emotional trades. What I'd rather do is wait for the re-rate to actually finish. Let the multiple find a level the market will defend. Let it build a base. Then you can think about a defined risk way in. Something where the most you can lose is fixed, and you know it before you put the trade on. A cash secured put below where it finds support so you'd only get the shares at a price you actually like, or a debit call spread if you want to find upside without paying for 100 plus shares outright. The point isn't the specific structure. The point is you size it so a name this volatile can't take you out. And honestly, while a name like this is still re-rating, I'm watching, not touching. There's no rule that says you have to have a position. Being patient is a position. Let me be straight about the downside because there's risk in everything here. If you bought near the top thinking it could only go up, you'd be down around 30% in a month on no bad news at all. That's the price for perfection downside in dollars. And the flip side, it bounced about 3% on June 29th to close around 116. A bounce is not a bottom. A name that re-rated this hard can keep grinding lower for a while, or it can rip back up just as fast on a single headline. That two-way risk is exactly why you only play it with defined risk, if you play it at all. So that's the whole thing in three pieces. One, priced for perfection means the expectations are already the bar, so no bad news isn't good enough. Two, a re-rate lowers the multiple without the business changing. And three, this was the theme getting re-rated, not a Palantir headline. Run any high flyer through that, and you'll stop being surprised when a great company has a brutal month. Quick reminder, this is education, not financial advice. I'm not telling you to buy or sell anything. Do your own research. That's it for this one. If this helped you understand why a stock can fall on no news, hit subscribe, and I'll break down the next priced for perfection setup. Drop the name you want in the comments. Good luck in the markets, no matter what stock you're into.